Hello and welcome to this episode 8 of Investing Not Rocket Science. In the first episode, I defined a basic portfolio framework for this investment of 1 million US dollars. I intend to invest into equities and bonds, and I intend to actively manage this portfolio without the use of leverage, with a time horizon greater than 5 years, and the investment universe that I'm looking at are the developed and emerging markets. The benchmark for this portfolio is the ACWI Investable Market Index. From episodes 2 to 5, I added Google, Emerson, and Infineon as the first three equity additions to this portfolio. And in episode 6, I evaluated government bonds and shortlisted the UK gilts. Next, I shared a portfolio update in which the portfolio was up about 1.3%, while the benchmark was down minus 3.8. Beginner's luck. In the next episode, I evaluated automotive stocks and shortlisted BMW to be added to the portfolio, which I've already picked up to about 3% of the portfolio. In this episode, I wish to evaluate financial stocks, and I look to add one or two or three of them to this portfolio. It's a large space, and I'll need to split this up into US financials, Asian financials, and European financials. In this episode, I'm considering a few European financial stocks. All right, so what are they? BNP Paribas, UBS, Standard Chartered, ABN AMRO, and Deutsche Bank. All right, company financials. Market cap to revenue. All of these banks are trading above their annual revenues, except for Deutsche Bank. Right, so Deutsche Bank is either undervalued or there's something else going on here, which is what I'd like to evaluate in the next few minutes. All right. In terms of net interest income and interest income on loans, typically the ratio is about half, except for ABN AMRO, which retains a lot more of its almost 70% of the interest income on loans it eventually manages to retain. And Deutsche Bank is quite impressive as well, at about 57%. All right, in terms of earnings yield, Deutsche Bank is about 22, ABN AMRO at about 12, Standard Chartered about 10, UBS about 11.5, and BNP Paribas at about 11.2%. So, with just this information, I would say that Deutsche Bank is probably a shortlist with just this information. Let's move on. All right, efficiency, valuation, volatilities. Okay, return on assets. You can barely see it. Not surprising. It's been a low interest rate scenario. So somewhere between 0.4 to 0.7% are what European banks, that's their return on asset. Operating income margin, BNP Paribas is at an impressive 28. UBS and Standard Chartered as well. ABN AMRO Bank is at about 30%, and Deutsche Bank is at about 21.8%. PEG ratio, Deutsche Bank is at about 0.03. That's the lowest. And price to tangible book, Deutsche Bank is at about 0.4, which is also quite reasonable. I mean, among these, it's the least expensive stock. 4.6 times price earnings ratio is 4.6, while ABN AMRO is at about 7.7, Standard Chartered about 10.4, UBS and BNP Paribas, BNP Paribas at about 8.8 in terms of price earning ratio. Okay, so going by this, I would again shortlist Deutsche Bank to be the preferred stock amongst these five at the moment. Okay, and on revenue growth. Okay, so European banks have pretty much flattish revenue growth, and with a dip during the pandemic. However, I see that Deutsche Bank's revenues have improved in this period from minus 9.1% to about 3.8%. While 3.8% may not seem like much, but from a minus 9.1%, it does look like the stock or the bank is recovering from a period of financial underperformance. In terms of net interest income, pretty flat. Non-interest income, BNP Paribas has got a bit of volatility in its overall interest and non-interest income performance, whereas the other banks over the last 5 years have remained relatively stable. Um, okay, so we see here Standard Chartered. The non-interest income has appreciated slightly, has improved from about 6 billion to about 8 in the last 5 years, and same with UBS as well, has shown some improvement from about 23 billion to about 27 billion currently. Okay, UBS is primarily a asset manager or wealth manager. So most of the income comes in this category, non-interest income. All right. Operating income margins in, well, again, pretty flat, but the trend somewhat rising, except for ABN AMRO, which has gone through some volatility. The most impressive, I think, is Deutsche Bank. From an 8% operating income, it has improved to about 21% currently in the last 5 years. That's some sort of a recovery there. Okay, let's look at loan provisions. Right, the biggest book has got the most amount of loan provisions, but we're looking for trends in this data, and they're all pretty much the same. Rose during the pandemic, has tapered off, and some apprehension about the future, and so banks seem to be slowly increasing their loan provisions as well. Okay, let's look at fair value. I've looked at competitive fair value using Investing Pro and a upside to that fair value, and I've looked at analyst targets as well. From this perspective, once again, Deutsche Bank looks to be most impressive in terms of the competitive fair value and the upside of about 30%. While most of the others are between 21 to 26%. In terms of analyst upside on analyst targets, again, Deutsche Bank is about 16%, and UBS and Standard Chartered around 8.5 on an average, and ABN AMRO at about 2.7%. All right. So going by what I have looked at and the data that I've looked at right now, Deutsche Bank looks to me is could be a dark horse, or I could be wrong. I'm not seeing something here. I've just done a basic evaluation, but it does look like Deutsche Bank should be added to this portfolio. It is a less expensive stock, and in terms of its financials, it has seen some recovery. Okay. In terms of the chart, Deutsche Bank has been trading along the same line for the last 5 years. So clearly, it had even touched about 5 euros to a share, and it's at about 11.5 right now. So that's the Deutsche Bank story. In terms of portfolio action, at the end of this evaluation, I'm looking to buy Deutsche Bank and add it to the portfolio, and I put BNP Paribas, UBS, Standard Chartered, and ABN AMRO to the watch list. In the next video, I look to evaluate US financial stocks and see if I can add one or two of those to this portfolio. Why am I adding financial stocks? It's primarily because of the fact that in a rising interest rate scenario, the net interest income from these banks should improve and hence add to their earnings. That is the theory. Okay, this is Investing, Not Rocket Science, a series on building and managing an investment portfolio. None of this is expert advice. I'm just learning alongside you. We can connect on LinkedIn. Please visit our website for more information about the series and for the disclaimers and terms. Thank you for watching. Thank you for your time, and I look forward to seeing you in the next episode. Bye bye.